Hello everyone and welcome to another video. As we have been explaining, we are coming up with more content on a daily basis. We will be uploading at least a couple of videos apart from the weekly market forecast in order for us to be able to help most of you out in understanding more of where we are coming from and what type of service we provide for our members. So for today's video, we are going to talk about the importance of trading time and not price in the market. And I will explain giving an example with gold. Of course, there are several examples, but of course, for the sake of this educational video, we are going to talk about the examples in gold. Of course, we will not be providing as detailed information as we provide into our service for our members because that wouldn't make any sense. But this should give you a rough idea why it's more important to trade time than price. Now, one of the things that we have to understand is that financial markets, they operate with time, right? As we have the monthly, we have the quarterly, we have the yearly, and so on and so forth. And then we break down the charts down to the weekly, daily, 8-hour, 4-hour, or 1-hour charts. This is how the markets are operated. They have cycles, they have different times that we see different behaviors, and when you are trading, it's much more relevant for you to trade time and not the price, and I will explain now the reasons. So just if we take an example for gold during the last couple of months, we have been seeing a bullish market and a decent pullback after the highs from the 30th of October. So, for example, for our members that they know how we analyze the market and what we do. For example, if someone was a buyer in gold, because everyone should have been a buyer in gold during the year. If not, then you are doing something wrong. You can consider checking us out and joining, and so we can help you to understand more about the bigger cycle. But in any case, let's have a look at possible entries in the buy side for gold. So for our members, they were aware about the lows from the summer, the May and June. This was an accumulation zone for gold. So if someone was buying gold from here, you are looking for a swing to the upside. Of course, you need to have your exit points, right? Most of the people they tend to create targets based on previous support or resistance levels, which most of the times they don't work. So as you can see in this example, we have got a new high on the 17th of July before the market provided with a pullback. Then we have generated another buying area over here in August. Then the market made another new all-time high and then it accumulated. This was another indication that buyers were still present in the market, and then the market make another new all-time highs. So you can see that this was a trending market. Now, of course, when you are trading a trending market, you need to understand that you need to define what type of trader you are, whether you want to be, first of all, a swing trader, right? Or whether you want to be a day trader, or what we call short term, right? Now, for our members and our service, we do not day trade. We don't like gambling in the market. So for this, I would say that I will put an X here because this is the wrong way of doing things. you should be a swing trader because you want to trade when the market gives you a decent reaction, so you minimize your risk and maximize your return, and you have a higher, let's say, a better risk to reward ratio and a healthier, let's say, approach into the market. So for the sake of gold here, for example, if we were to be buying this one from the end of June, we would have outlaid a time frame in which we want to take profits. And why this is important? Because sometimes you might think, okay, let's say I bought from here. I want to set up and look for the previous highs. So you might have gone out here with 1 to 2 risk to reward, and you might have benefited with a 3.88% move. But if you understood the concept of time, you might be able to actually take profit somewhere here, for example, right, which is 5.7%. So it's very important to understand that time is better than trading price, because this can also save you for potentially more losing trades, because the market doesn't really care about prices, but the market operates in cycles and times. This is one of our many tools and aspects that we teach our members how the market works. That's why we have outlaid our chart with a lot of dates. If you have been noticing from our weekly market forecast videos, we are actually labeling a lot of dates, and there is a specific reason for that. So of course for that you would need to be a member to understand uh, about the dates and why we put them. And there is more into it that I cannot disclose, as I said before, because this is provided for our service. So what I'm trying to say at the end of the day here is that you're better off trading time if you learn how to split the market with different segments, and in this way you would be able in the long run to benefit from a better risk to reward ratio in your trading, and this will improve many things. One of them is something called profit factor, right? Because without a healthy profit factor in the long run, you are going to be losing money for sure. The other thing that you are actually improving, it's called the expected payoff, and also the recovery factor. Now, if you don't know what these terms stand for, we would recommend you to Google them and learn a few things about these factors. We are going to present to you soon, in the near future, we are planning to present to you some detailed trading results, and we will explain everything about these factors and indicators. So you will be able to understand in a better way why these are relevant. For example, the profit factor for a swing trader should be far greater than 3, ideally. The reason is because if it's below 2, it means that in the long run you might be losing money because of obviously overnight charges or from the commissions and so on and so forth. So you need to have a profit factor of more than 3. And I will leave it to here because I don't want to confuse most of the people, because I'm pretty much sure that 90% of the viewers, they do not understand what are these factors are. So we would recommend everyone to learn more about them so you can understand why they're relevant, because at the end of the day, trading is no different than being able to manage your own funds and as a business. So for any business, you have expenses and you have revenue and some other things you need to consider. So this is how you need to be trading as well. Now, for the sake of gold again, as I said before, Uh, Coming back to our most recent forecast, which you have got it for free as well with the previous weekly market forecast, we have outlaid here this trend-based Fibonacci extension area, which is a reaction area that we expected a bounce. So this is where buyers are trying to defend after this dip that we have seen in the market. The market has already reacted from the lows to the highs about 4%. So if you were to have this buy from here, let's say, and you wanted, so far you have been in profit about 3.24% if you bought even from here. So ideally now, what you want to do in general is make sure you eliminate your risk. For instance, at the moment, the market it's about to retrace to the 50% from this decline. So it might be a good idea that you have your stops at your entries. And now you are creating a risk-free position. So if the market was to turn, you would not lose anything. You have the other option of taking partial profit and the rest is at break even. So now if you were to buy from here and you are here, you need to understand that it's not about price because we have several possibilities. Either from here the market is going to pull back and make another move to the upside, or the market might resume the downside, right? These are the two scenarios. So depending on which one will play out, you need first to have your risk-free position, and then you need to decide what is the time frame that you are willing to sit on this trade. If this is a recovery bounce, it might take, for example, up to 2 weeks, it might take 3 weeks, it might take more. If it's a reversal, it can definitely take more than 2 weeks and the market should be pushing to the upside, right? So this is just an example. We are not forecasting what will happen next. We are just explaining to you some of the differences. So this is what we really go into detail when we have our sessions with our members. We explain the bigger picture of the market. We explain why certain things have a higher probability chance and why some of them not. And depending on our trade recommendations, we suggest to our members and we explain to them what is going to be the rough estimate of time that we are willing to sit in a specific trade. For example, we had a trade since the last month in which we are still sitting on it. The trade is in profit, is on risk-free. We will disclose the trade later on once we are out and once we close it. So we will let you know about that trade, but it's deep in profits and it's a huge market swing that we are trading at the moment. So this is just a few details about trading time and not price, because at the end of the day, the market runs in cycles and they tend to have certain times into them. So if you want to learn more, of course, feel free to join us. The link is in the description. If you have any questions, you can actually send us an email at support@roiforecast.com if you have any questions related to our service, or if you want to comment on this specific topic, let us know as well in the comments. Otherwise, don't forget to leave us a like and subscribe so you can help us out to reach out to more traders. And stay tuned because 2025 is a big year. We are planning many things. You are going to learn a lot of things from us. You will learn the actual things that most of the services will not tell you. And we are going to have some exclusive interviews and podcasts with some industry professionals, and you will learn many more things. And we are doing all this because we want to provide truthful and transparent value to the people, and we are on the side of the people and not the other way around, because in this industry there is a huge conflict of interest, which we are going to dive deeper in our future videos. So for now, thank you so much for watching, and stay tuned for the next video, and have a good rest of your day. Bye bye.